Good afternoon and welcome to the HARGREAVES Services PLC preliminary results investor presentation. Throughout this recorded meeting, investors will be in listen-only mode. Questions are encouraged, can be submitted any time by the Q&A tab situated in the right-hand corner of your screen. Simply click Q&A, type in your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company can review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, I would like to submit the following poll. I'd now like to hand you over to Gordon Banham, CEO. Good afternoon, sir.
Good afternoon. Thank you very much. Thank you, everybody, for taking the time to listen to the HARGREAVES presentation. I always welcome these presentations as an opportunity for retail investors to engage. You obviously have the forum here to ask questions, but Stephen and I and Simon are always available in the interim stages. So if you ever want to drop us a note and ask any questions, please feel free to do so. So let's just talk about the team. I think everyone knows myself after all these years. Stephen, I think everyone knows as CFO, but the person you haven't met is Simon. So Simon has joined us as our Chief Operating Officer. Key function is to drive the growth of the services business. So I'll just give Simon a little opportunity to introduce himself to you all. So Simon, please.
Hi, pleased to be here. Hello, everybody. I'm Simon Hicks, obviously. I'm an engineer by background. I've been 35 years in energy and infrastructure, broken into a few key chunks. One is the first 10 years of my career was in building gas-fired power stations, both in the UK and the US. I then spent 5 years leading a logistics business, 15 years, which is the bulk of my experience in UK and overseas services, similar services to Hargreaves offers, very similar customer base, key standout projects involved in Hinkley and the nuclear island, involved in the carrier contract, building the carriers. Ran a very large services business for a number of years until we were acquired and put into private ownership. Stayed on for 3 years to integrate that business and then moved on to run 7 energy from waste assets for UK pension funds. And then I'm here at Hargreaves, really pleased. Why is that important? I guess common customers, understand the sectors and have good, strong relationships with our key customers in the markets in which we operate.
Thanks very much, Simon, and welcome on board. So just but if you'd bear with me, those who are our existing shareholders know the value proposition, but we may have some new people who are not quite so familiar as yourselves. So what we explain to everyone is that the business has basically 3 pillars. So the services business will be covered in detail by Simon. Simon has been brought in to drive the growth. We think there's a lot of opportunities there, and he'll talk about that in some detail. Then we have our land business. Now, our land business is really simple in 2 parts. First of all, you have the land that was part of our old mining businesses, so it's held at historic cost. That's a very important point. Alongside that, we have renewable assets. Now, they're on the books at about 7 million. Jones Lang LaSalle have valued them every year. Again, they've revalued them this year and said they're worth 27 compared to 7. So you've got 20 million of uplift. We've made it very clear to existing shareholders, the plan is that you add the 80 to the 20, you have 100 million of value in your land portfolio. And the plan is to sell that down to 20 million over the next few years. That will release 80 million of cash. And you'll have a business which has got 20 million of cash tied up, making about a 20% ROCE, so making 4 million a year. Now, one of the great benefits of Hargreaves is the fact that we have cash in the bank, we have no bank borrowings. So the timing of that will depend on where the market sits, and I'll pick that up in a bit more detail. But the most important thing is the value is there and it's captured. We haven't written the prices of the land up. So there is a lot of intrinsic value sitting there waiting to be harvested. We appreciate the time value of money. So we're not going to, on one side, rush and sell it at distressed prices. At the same time, there's a lot of value there for shareholders, which we will realize in the next few years. Finally, is HRMS, the German business, 2 parts, trading plus DK. And I'll talk about that in detail, 2 parts of that business, and I'll explain what's going on there. So just flicking on to the next slide, key highlights. what we have always said, and we're still consistent, is that we will be paying shareholders to wait while we realise value from our portfolio. So we've put the dividend up by 3%. The underlying profit before tax is up by 4%. And you might say, well, that doesn't look very much, Gordon. Well, the answer is land had a very good year last year, and therefore that's gone down. But services, which is obviously less lumpy, much more recurring in income stream, is up significantly. And again, Stephen will pick that up in the presentation. As I said, again, we have over 23 million of cash in, so we're in a very solid, safe position. So on that note, I think I'll hand over to Stephen, who will just run through the financial numbers for everyone. Thank you, Stephen.
Thanks, Gordon. So first slide is the usual run through the P&L for what happened in the prior year. If I start looking at revenue, revenue's up significantly on the prior year, 25% growth, up to 264 million. 19% of that growth coming out of services, so up to 244 million, and that growth in revenue is coming from an increased volume of activity, predominantly on major infrastructure sites, but also a growing baseline of smaller contracts, which we've been building up over the last over several years now. We've also seen a significant growth in revenue within Hargreaves Land. This is a slight anomaly because of the way that revenue is sometimes treated within our land business because of the split of assets we have. Last year, we sold 2 significant investment properties for total combined proceeds of around 13 million. Because they were investment properties, they did not class as revenue, which is why the revenue looked lower last year. So that's part of the growth in revenue this year. What does that mean for profit? Well, in underlying profit before tax for services, we've delivered 15.9 million in the year, which is up from 11.4, significant increase. So part of that is off the back of the growth in volume on these major infrastructure projects and other contracts. And probably most pleasingly is also the read-through to margin. So we're putting higher volume on the same overhead, delivering a higher margin, 6.5%. So real good progress through there. And it really sort of demonstrates the quality of contracts we are working on. We're not looking for high volume, low margin. We're looking for good quality margin that rewards our high quality health and safety, ESG, and our high quality systems. Looking at land next. So land, on the face of it, profit has come down from 8.2 to 2.3, but I would stress last year was a record year in the history of Hargreaves Land at 8.2 million, and we did always flag this would come back more to normality, which is what has happened this year at 2.3 million. Gordon will pick up on some of the key transactions in there, but it has been nice to see a couple of sales complete within Blindwells during the year. Our share of profit after tax of HRMS, which is our German joint venture, is the next element here. Profit up from 1.3 million last year to 4.1 million. A lot of that growth is in relation to the DK recycling facility, which I'll touch on in a couple of slides' time in terms of what's driven that. Corporate costs and interests are slightly higher than they were last year. Large driver behind that is last year we had the benefit of interest income on our defined benefit pension scheme. For those of you who followed the story, you will know that we bought in the pension scheme at some point during 2024, and therefore that opportunity for upside on that interest is no longer there. That's the main reason for the difference. That gives us underlying PBT of 17.5 million, up 4%. So a lot of moving parts in that growth. Everything else is fairly straightforward. I think the tax rate is ever so slightly lower than it was this time last year. This year's effective rate is 20%. Last year was 25%. The reason for the discrepancy is last year we had a prior year adjustment relating to the tail end of the super deduction. Elsewhere on this slide, dividend up 3%, but something I'd like to draw people's attention to is EBITDA is increasing at a faster rate than our PBT, and that is because of the mix of our profits, more coming out of services than land. So just over the page, where is all of the capital tied up in the balance sheet? So if I go left to right, this is a fairly similar story to those of you who followed us for a little while. On the left, services, total capital employed of just under 8 million. It is up from 5 million. I think last year we had an exceptionally low level of working capital in services. Typically, I would expect this to be between 7 and 12 million, depending on timing and how much volume of work we have on. High level of tangible fixed assets in services is plant equipment, yellow plant, diggers, dozers and such like, funded by leasing debt or HP. If I look at lands, next column along, 83 million of capital employed, slightly up on the prior year. That's due to continued investment into blind wells. However, the pleasing thing is this is down from our November presentation, so we're starting to see cash come out of land, albeit modest at the moment. And just a reminder, everything in land is held at cost, so any fluctuations in market price values don't affect our balance sheet value. Next column is HRMS. So this is our share of the German joint venture, currently sitting at 68 million in total, split as 54 million in terms of our investment, which is profits built up in the German joint venture they haven't yet paid to us as a dividend, and 14 million in other working capital loans. Most of that is long-term loans to secure funding in Germany. And within the unallocated column, two things I'd pick up on. One is the deferred tax asset, which is down to 7.8 from 11.3 last year. That's really demonstrating the fact we are using our tax losses, which we said would happen, meaning we reduce our tax payments. And then cash, important to remind everyone, positive cash balance of 23 million. We have no external bank funding other than the HP. So very solid balance sheet. Next slide just considers some points for valuation. If you're making your choice, your opinion on how Hargreaves should be valued, just laying out some factors to consider on this slide. First of all, our services business, good level of earnings, good visibility going forward. Clearly, some sort of earnings multiple would be appropriate here. So we've listed the EBIT number and the EBITDA. EBITDA now grown up to 30 million on the services business. So in terms of multiples, you can add whatever you want to that. Land, Gordon's covered this in quite some detail, I think, already, but base value cost of 80 million with a renewables uplift of 20 as now reconfirmed by JLL, gives us over 100 million of value sitting within land, which we plan to unlock over the next 4 to 6 years. And then on HRMS, book value is just under 70 million now. We are receiving an annual cash dividend of between 6 and 7 million, which we are using to fund the dividend out onwards to our shareholders. And we will continue to focus on getting cash out of that business to fund. Next slide is just a quick cash flow. So we started the year with 23 million pounds in the bank. EBITDA broken down there as operating profit, add back depreciation and less the sale of fixed assets was just under 34 million pounds. Small movements in working capital, and then interest, tax and capex are fairly standard and straightforward, I think, to understand. We then received our dividend from our German joint venture this year was 6.3 million. The next line is a bit of an unusual one. This is a 4 million cash receipt from the pension fund. So if we looked at this slide 12 months ago, that would have been the other way around, because when we bought it in the scheme, we had to lend 4 million pounds to the trustees for them to purchase the insurance policy. They did that and have since recovered funds from the underlying sticky assets they had, and they've repaid the 4 million pounds to us in total. Next column relates to lease payments. This lease payments number is high compared to previous years. Part of that is because we've invested in plant and machinery in order to fund the growth in revenue on these major infrastructure projects. And as you can see, the leasing payments broadly cancel out the depreciation earlier on in this slide. It's never going to be one for one. And in this year, I'd say leasing payments are slightly higher than I'd expect them to be going forward. Paid a dividend of 12 million pounds, which ended us the year with 23 million. And then the next slide is really just to give a little bit more colour on HRMS, because if you looked in the announcement that went out this morning, you can't see too much on HRMS because it is a joint venture and all you see is the share of profit. So on the right-hand side, we have a table just outlining some of the key financials. In green, we have the revenue for the two elements of the business. If I start with HRMS, the trading business, revenues are down to just under 180 million from 220, and that is not volume related. Volumes have been pretty standard. What that is commodity prices have come down yet further. Predominantly coke prices have come down. So whilst that's reduced revenue, HRMS have been able to hold the margin. So margin as a percentage has gone up to 5.7%, but they've held the PBT at 10 million. So really strong performance from the team over there in what is a challenging market at the moment. The other side to that reduction in coke prices, though, which has reduced revenue, has benefited in DK. So DK profit, you can see in the yellow, or rather a loss, I should say, in the yellow, has reduced from 7.4 million loss last year to 1.4 million loss this year. Two main factors for that. One is the securing of solid fuel prices. being coke in the main, is significantly better than it was 12 months earlier. So prices have come down, reducing the input cost. And secondly, gate fees on the waste material have been improved this year, which have again helped to improve the result within DK. And Gordon will touch on a few other factors in DK that could further move that going forward. At the bottom of the table here, we just breaking down really what was on a couple of slides previous. What is the total exposure to HRMS? We're now down to 68 million in HRMS, which is reflective, coming down 2 million, reflective of the fact that we received a dividend and that was offset by some further profits in the year. And I will hand over to Simon to talk about services now.
Thank you, Steve. Just to start with, first time I've talked about services, and what reflecting on this, the important thing to remember is the markets in which we operate. We operate broadly, for me, in three key sectors. It's called connectivity, which is transport, getting people from one place to another. Transport, rail, airports is in that sector. Energy and net zero, that transition of the energy base into a zero carbon place, and the environment, which includes water and waste. It's publicly known, lots of announcements that folk will have seen as to the increase in that infrastructure core market going forward for the next 5 to 10 years, which positions the services we offer in a very strong place. Remember, though, that 70 plus of our contracts, and that's grown this year from 65 up to 70, are in assets that already exist, and assets that we maintain, we operate, and we look after for our customers. So what does that mean? It means that with those secured orders, we've got a strong pipeline of orders. We can be selective on the work that's coming towards us as part of the infrastructure pipeline. And it's really important for us to remember being selective is the thing that protects our exposure to credit. It allows us to make sure our contracts are inflation resistant. We've seen that in recent years when inflation's been higher, we've still delivered the results that we've been delivering. And it gives us that resilience in our base market to drive selection. And that's all leading us to those positive cash flows, good strong cash flows this year, really good return on capital employed. And for the first time, we've gone over 6%. So you've seen in Stephen's slides, we've gone from 5.6 to 6.5% margins. So the more work we bring through as part of that forecasted increase in the market, that'll drop straight through to our bottom line. So really strong business with really positive outlook. The sorts of services we do, you'll not see on the high street. We're not in retail, and we're not in one-stop, one-off project construction. We do deliver major projects into new build, but the bulk of our business is in services that we offer to customers that exist. You know, mechanical engineering, turnkey engineering. We've got a very strong presence in waste management, bulk handling materials, a transport business, and a land remediation business. So as we mature our customer relationships over a number of years, which we're doing, we start to pull through these services and increase the amount of revenue we're taking from our customers by delivering a really strong, excellent service. What underpins the model is the quality of the people that we employ and their ability to deliver those services in a safe, efficient, and effective way. We've got real strong focus within the teams to make sure that we deliver to our customers what they require from us. So taking a look forward, the pipeline, some successes this year. You take the connectivity sector, HS2, 2 more seasons to run. HS2 is now taking us forwards to the Lower Thames Crossing project with a preferred partner there to Balfour Beatty. So as HS2 starts to run off over the next 2 seasons, we'll see the volumes increase in Lower Thames Crossing. And of course, that now announced growing pipeline of infrastructure starts to think about things that are further in the future. Most important one on the horizon that we can see is, of course, the Heathrow expansion. Blackwell business already has been active in that space when we delivered the Terminal 5 upgrade. And of course, we did the initial design work for that when it was on the drawing board. So we know that project, and we're quite optimistic about that coming forwards. Energy, again, strong tailwinds. Sizewell C went through FID last week. We are doing the enabling works there on the earthworks service provision, and that now will move forwards into the main construction islands and the associated infrastructure around that plant. So nuclear in energy, clean energy, very important sector that we're very well positioned in, and it's a sort of customer where we can deliver a good service and pull through additional services that we showed on the previous page. Not forgetting, of course, that we're already across the UK energy sector. We deliver to energy from waste companies. We're supporting energy companies in multiple clusters. A number of those are considering decarbonisation options. We're well placed to take advantage of that. And we're supporting the growth in the other bit of the nuclear power sector, which when it comes forward, the nuclear fusion reactor at West Burton, we're already positioned on that site doing work through our industrial services business. Moving to the environment, we made good progress here. We've now secured new contracts with Yorkshire Water, Northumbria and Severn Trent Water. Really good service we're providing there through both our industrial and our environmental businesses. And our SBU business that we acquired a few years ago is well positioned in some frameworks for the end of AMP7 and moving into AMP8 cycle now. So we're supporting the water customers in that space, and not forgetting our earth moving business, of course, with the rollout of the country's new 9 reservoirs. We're already doing the trial pit digging on 2 of those reservoirs, and we'll see our relationship with that increasing and improving over the years. So what we're saying here is good sector spread, which gives us balance. We're in sectors that are forecast to grow over years, and we've got really strong long-term relationships with customers in those sectors, high quality blue chip customers, providing us with confidence that we continue to grow the services business in this space.
Thank you, Simon. So just moving on to the land piece, again, for people that don't know us, just want to highlight what we do really. So 2 parts to the business. We owned a lot of land, which was to do with the old mining business, and that's held at historic cost. So therefore, we're working through that as a multi-phase master developer. We're doing bespoke commercial development. So we're working on that section alongside its renewables. Now, a lot of our land is in Scotland, and therefore there's a lot of wind farms, batteries, solar on that. So those are the 2 parts of the business, as I mentioned earlier. One of them sits with about 80 million of balance sheet there. The other is in that 80 is 7 million of renewables worth about 27. So you've got 100 million of value, land at historic cost in here. So it's all about harvesting that. So just take you over the page. Blindwells is our flagship. It's about 40 million of cash tied up in there. And you can see that it's a fantastic site close to Edinburgh. So that site will continue to be sold down and generate that cash. Also working on Unity, and we're looking to sell some of the renewables. Now, key point is that the property market is a bit quiet at the moment. Let's be honest, you can see that everywhere. We're not concerned because we're holding the land at a set historic cost. So the important thing is we will, as a board, make the decisions on when we look to sell bits and pieces as it's appropriate to get the best value for shareholders. So that's the land piece in itself. Just want to move on to renewables. So the good thing for everyone is Jones Lang LaSalle did another revaluation of this portfolio and has confirmed that it's still worth about 27 to 29 million. We mentioned earlier that we brought to the market about what Jones Lang LaSalle valued at nearly 13 million of assets. We are in detailed discussions to sell that portfolio, and I hope to make an announcement shortly on that. Probably a little bit later than I would have expected, but fine, we're determined to get the best price. So I hope to very shortly update that. Remember, we talk about, so Jones Lang LaSalle have only valued 27 to 29. We then have these further out schemes further down, which we think will add some more significant value over time, and we will update the market each time on that. Finally, in land, as I said, you start with 100 million. We're going to trade it down to 20 million, delivering a ROCE of about 20%, so making about 4 million. And this is all about the future. This is about option agreements, promotion agreements, etc., that we have, and we're building that pipeline. So as the cash comes out, it will turn into much more this option type business. And this is just giving you a flavour of how that's growing and how we're securing that long-term stream from that type of business. So land, the outlook is very good. We have, real upside coming through, and it's just going to happen over the next 3 or 4 years. Just take me over the next one. Thank you. So this is just Germany. So remember, Germany is split into 2 bits. Again, for those of you who do not know us, there's a trading business that's ring fenced from DK. So those are the 2 bits of the business, really. Trading business. So if we talk about that first on the next slide, we always said to everyone, it will trade in this blue box range between 10 and 15 million. Guess what? Everyone knows that Europe's had a quite difficult last 12 months. Guess what? We came in at the bottom of the range. The volume was still very similar to prior year. So happy with the volume, and it made the number we expected. So, nice steady recurring income. But I've always said to people, it's a trading business. So please, in your own head, as a sum of the parts, value it as book. And one day when the trading team have decided they want to retire, we'll just close this business down. There's no closure costs because it makes about 1 million a month. So when the traders retire, we'll just close the books, 3 months to clear the inventory. That'll make 3 million and that'll deal with the closure costs. But like I said, we have a great trading team. They're keen to move forward with us. But one day it will close down when they retire, and then you'll get book back. DK Recycling is the interesting thing. So what does it do? Again, for those of you who don't know, it takes waste dusts from steel plants across Europe. There is really a little bit. So the options, if you're a steel plant, is you put it into landfill, you give it to us, or there's a small amount that can go into the cement sector. So really, as the ESG agenda pushes into the steel plants, they really have to come to us instead of go to landfill, and that gives us pricing power. What we do is we mix about 500,000 tons of dust with coke and coal in a blast furnace, and you produce pig iron, zinc, and energy. The energy is, we sell a little to the grid, but basically we're protected from spike in energy price because we generate our own power. So what really drives the profitability of the business? Well, if you think about it, it's pig iron prices, zinc price, and gate fees. So that we're looking to drive gate fees on. In the period, we were able to not only drive on gate fees, but also we were able to reduce the cost of the input raw materials, the coke and coal. We did expect pig iron prices to move up due to Russian embargo, etc. Now, the Russian embargo's kicked in now. It's effective from September. Obviously, everyone is appreciative of the fact that with the tariffs on steel, the market's been very, very flat. So it hasn't moved up very much. But to give you an idea, a 1% movement in pig iron price adds 1 million to the bottom line. So I'm looking forward to updating you in January about what's happened with pig iron prices. I think they're on the floor at the moment. Can't see them going much lower. If they move up, that will be a positive thing for us. So just over the page, ESG is very important to us. And I'd like to reassure you, as a fellow shareholder, that this is not about ticking a box. It's what our customers are demanding from us. And this is all about value for money for you as a shareholder. So the customer wants ESG. We're providing what the customer wants because that helps us win work. So the team in the ESG team are held accountable by the divisional MDs to make sure they're helping them win contracts. So we don't have this ESG team. They are a value add, not just an overhead. So they're keenly focused on delivering value to the business. So ESG is part of what we do. It's important. So in summary, just take you through to recap. Like I said, a lot of you know this. So really starting at the bottom, Germany continues to pay the dividend. Great. Bottom of the cycle, we expect that to move up. Land, you've got a huge amount of value in there. We hope to throw off about 80 million of cash in the next few years with the sale of renewables and the land assets at least. If we get better than book, clearly you'll get a profit on top of that as well. So land will go down to a much smaller business, making about 4 million. The big driver is the services group, and that's why Simon's joined us to give it that focus and attention. Those of you who know who have been on the journey know that the group has come a long way. Now is the critical moment to really take that opportunity in services. And I have to say, again, those of you who've been with me a long time, we're probably in the best place I've ever been. We've tidied up the history from a coal company to a green company, and now, and you'll have to. I'm not taking the credit for this because it wasn't about positioning. We've been very lucky. The sectors that we live in and we are exposed to are going through a golden patch that we will look to capitalise. And that's why Simon is here to help me with the execution and take those opportunities for shareholders. So just over the page and to complete before I move over to questions, please remember you have a very experienced board. You have Roger McDowell. You also have Harwood Capital represented on the board. So as our biggest shareholder, that means there's some very strong shareholder alignment. Also strong balance sheet, no debt, so we don't have to do suboptimals. We are very conscious, a number of our shareholders are keen for the dividend. So again, you'll see it was increased by 3% to reflect inflation. So we're keeping pace with that. And I think we have 3 very strong pillars that are easy to understand for people and work out the value of the business as some of the parts. So look, that's done the presentation. I think I now hand over for...
Fantastic. Absolutely, Dirk. Thank you very much indeed. Ladies and gentlemen, do please continue to submit your questions just using the Q&A tab situated in the top right-hand corner of your screen. Just while the team take a few moments to review those questions submitted today, I'd like to remind you a recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we've had a number of questions submitted, both during today's presentation and pre-submitted. Stephen, if I may just hand back to you just to read out those questions where appropriate to do so, and once completed, I'll pick up from you at the end.
Of course, yes. First question, Gordon's probably for you. This is a pre-submitted question. Has there been any improvement in the profitability of the German coal pulverization plant?
So for those who don't know, the business has a pulverization plant that basically grinds coal for cement plants. It was positioned to replace the lignin coal mines that are in Germany. Now, interesting fact, for those of you who don't track it, is that Germany still has a huge carbon footprint because it runs a lot of its power stations on horrible lignin brown coal because of the issue in Ukraine and the fact they closed their nuclears. They are still continuing to run their lignin brown coal mines, which is huge CO2 footprint. When those close, that will open the opportunity for this grinding plant to supply the cement industry in Europe. Remember, cement will always produce CO2. It doesn't matter if it burns coal or not. It's part of the chemical process. So they will have to fit carbon capture. So at the moment, it hasn't moved, but we still think there's a good long-term future for it.
Thank you. I think you picked this one up, but just to close it out, John's asking, when do you anticipate the sale of some of the renewable assets to be completed?
In the very near future. Thank you for asking. To be honest, I expected it to happen before this roadshow. And some of these things take a little bit longer, so it's really irritating. I will be really disappointed if I'm on the roadshow in January and that hasn't happened. We are at very advanced stage. So don't be surprised. Hey, you might see it in a couple of weeks, but it isn't very far away.
Thank you. I think this one's relating to services. So Paul's asking, with strong cash generation and improved profitability, are there plans to pursue bolt-on acquisitions, particularly in services and renewable energy infrastructure?
Currently, no. There are no firm plans. Obviously, as time goes by, we'll consider things, but currently there are no firm plans.
Thank you. Brandon has asked a few questions in a row. I'll take them one at a time. Gordon, Tungsten West seems not to be mentioned this time like it has before. Has confidence in the start of the mining decreased?
No, it's a very good question. People ask that. It's just a layout, but I'm glad you asked. So if you're tracking Tungsten West, you'll see that they raised another 4 million, which gives us confidence that looks if it's going ahead, or at least their backers think it's going ahead because they've put 4 million in. Come December, I think we'll all know, because that's the deadline they've set themselves. They did pay us another 1 million, which they were contractually obliged to do, which was paid in June.
June, yeah.
Yeah, June. Look, if they haven't raised their money, they've got to pay us another 1 million next June. So look, if they raise the money, we have this mining services contract. If they don't raise the money, we will take the site back and restore it. So we're very comfortable. I think the focus, and it's a good point, with the layout of the presentation has changed a bit, but Lower Thames Crossing, Heathrow, things like this are really interesting. If we're not careful, put too much in there. I think the theme is there's a huge amount of opportunities for services. Generally, each time I come on this roadshow, the opportunity in the spaces we work has got bigger, not smaller. That's probably why it got bumped out of the presentation. It's all about, do you trust this management team to take those opportunities? The goal, as I put it, the goal is open. The goalie isn't even standing in the goal. Do you trust us to put it in the back of the net is the question, or at least Simon to put it in the back of the net, helped by me and Stephen.
Thanks, Gordon. I'll take the next one. So Brandon's just asking, or statement really, slightly surprised that a large proportion of the sales proceeds from Blindwells had to be reinvested into the scheme. So if you look in the presentation, we've had 2 sales, total proceeds of just under 14 million. Not all of that is cash up front, particularly the Avant deal is phased, so not all that cash comes up, but nevertheless, a sizable proportion does need reinvesting into Blindwells. As we've got, I think there's 5 or 6 new remaining plots left on the Blindwells site before phase 1 is completed. We still need to service and settle those sites before they're able to be sold. So we are at a peak. We have come down slightly from November. I expect over the next 3 to 4 years that to go away more significantly quicker as sales happen and the level of infrastructure drops away towards the back end of the site. So you have read it correctly, Brandon. I'll take the next one also from Brandon on HRMS. How much is the CPP, carbon pulverization plant, in the books at, and is there hope it might do more than break even? I think Gordon's covered the profitability point. In terms of what it's in the books for, it's in the books for approximately £24 million at the moment. That would stress that is part of the HRMS total investment number if you're looking for where it is actually on the balance sheet. And final question, I think, from Brandon, unless there's any further down, is there any way that the capacity within DK can be increased? It does seem to be a product that may be in demand.
The answer is no, but in some respects that's good because it gives me more pricing pressure. So you can flex it up by about 15%, but then you're pushing it. So I'm very happy at rather increasing the margin as opposed to the volume.
Okay. Another one for you, Gordon, I think from Martin. Is there any update on the position with CBAM?
Yes. So CBAM is still proceeding as planned. So nothing's changed on that. Nothing's changed on the Russian embargo on pig iron, and nothing's changed on CBAM. The EU have got to get together early 26 to review CBAM. So they're having another review and then setting it once and for all. On the Russian embargo, which is a point I should pick up, the Russian embargo is in place. No more Russian pig irons allowed into Europe. People brought in material. Those stocks will be exhausted. Well, they are actually exhausted now. A lot of the foundries have closed for August, so it's going to be very interesting to see what pig iron prices do in September, October. And again, I will have a real clear update for you in January.
Thank you. Next one is from Aslam. I think I can probably take this one. What is the value of the carbon credits from the planting of trees in the year? 170,000 trees. So we didn't plant 170,000 trees this year. That's the total trees we planted over the life of the schemes that we have. And we are not harvesting carbon credits from those trees. We're still looking at that tree planting schemes that we had and whether or not carbon sequestration is the most appropriate way to go with those. Some of those trees that we planted were an obligation of planning as well, particularly on the Blindwells site, to comply with our obligations there. So the answer is we haven't got any carbon credits in relation to those trees in the Hargreaves group. And I think this is the final question, unless a late one comes in from Martin. The large global wind turbine manufacturers have been highlighting a slowdown in the wind segment. Is this affecting the land business at all?
No, not at all. So in terms of the sites in Scotland, the ones that we expected are being built, and the ones that are further down the pipeline are still progressing. So no, it's not having an impact on us at all.
Thank you. That is all of the questions that have been submitted. Thank you very much for your interest.
Fantastic. Look, thank you indeed for answering all those questions. And of course, any further questions that do come through, the team will be able to review those and we'll publish responses where appropriate to do so on the Investor Meet Company platform. Just before redirecting investors to provide you with their feedback, which I know is particularly important to the team, Gordon, if I could just ask you for a few closing comments, please.
Yes, look, first of all, I'd just like to say thank you very much. We do value this interrelation with the retail investors. I've been CEO of this business for over 20 years, as many of you know. I genuinely believe that we are in the best place we've ever been. We are poised. Now, it's all about execution, but we are poised. Everything always takes longer than you expect. I think we're all realists on this call. But look, we've got the 80 million of value. It's all about timing, getting it out of land. Germany, it's all about taking the opportunity for when the market moves. And services, we are just very lucky. I'm not going to take the credit for it because it wasn't positioned like that on purpose, if we're honest. The opportunities are there. There's no goalie in the goal mouth. We just need to put the goal in the back of the net, and that's up to us whether you trust us to execute. But I'm really excited. Look at the opportunities on the reservoirs, Lower Thames Crossing, Tungsten West. There's just so much work out there. I think we've got a great opportunity. The news flows in the next 12 months will be very interesting. Hopefully a renewable sale. Hopefully one of the big infrastructure projects we'll be able to announce, and that'll lead to upgrades, some more land sales, etc., and steady delivery. So I think there's going to be quite a good news flow in the next 12 months. And I look forward to catching up with you all in late January, early February. So thank you for your attention.
Gordon, thank you, and thanks to the team for updating investors today. Could I please ask investors not to close this session, to be automatically redirected to provide your feedback in order the management can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of Hargreaves Services PLC, we'd like to thank you for attending today's presentation. That concludes today's session, and good afternoon to you all.